if you're wrong, you lose. If you invest $1 and you're wrong, you'll lose $1. Unlikely, you'll lose it all. If you're right, you'll get $10 or $20, and the probability of that. When I think of narratives, actually, I think of like the newspaper or any, like almost the Bloomberg report. Stocks fell today because so-and-so did this, or the market felt fair because of that. And it's absolutely bullshit, right? Like if you're in the market, you go, no, actually it hit the technical resistance and there was a bearish divergence and we rejected off that because all traders will have to sell because of that signal. That's why it rejected, and then someone found a narrative that also coincided to this day. And so when I look at the Bitcoin price, I'm like looking at fundamentally who's buying, who's selling, and then you can attach like, right. So like recently, the price has sold down very, very quickly off a week ago, and the narrative that's been attached to it has been, it's tax season sell-off. And wow, they left it last minute because the 18th of April is the deadline for many Americans, and there's assumed that that's tax sell-off. And you look at the data and it's like, well, overall, there was very mild selling from hodlers. Overall, spot was buying, mass amount of coins moving on-chain, off the exchanges. Actually, spot was buying. Who was selling? That was the futures markets. So you got this narrative that it was a tax sell down, but actually it wasn't. It was traders trading this correlation. So that's what I think about narratives in terms of price action. Like I think they're too coincidental to some sort of reasoning, but not backed by any kind of the fundamental data you look at if you're looking at the markets properly. It's real interesting in terms of like there was a lot of bearishness. Maybe we've got a little bit of a pump in the last 24 hours, but like it's been super bearish and people going, it's going 20 or whatnot, and capitulation is going to mount. But if you were to look at our valuation models like MBT signal and MBTS, every capitulation, like from the 2018 capitulation from 6,000, 3,000, or the COVID capitulation, they really started from medium to high levels of valuation of Bitcoin, according to that metric. And we're actually really undervalued right now. It's like, it's near extremes of undervaluation. So I think it's really hard to mount a capitulation because it's oversold to such a degree. So on-chain is like, at that stage of what we call mean reversion, it's so far out from its mean that the gravitational force is towards up, right, which is where it wants to be. And so anyone shorting this in correlation to any crash might have some success, but I think it's limited. It's limited because of that mean revertive force on basically fundamental on-chain valuation metrics. See these kind of long time frame metrics start to break down. If you look at it zoomed out enough, it's always going to revert. So yeah, I think we're undervalued right now, and it's hard to push it down. It's easier to pull it up on bullish correlation trade, harder to pull it down on the bearish trade. It's real interesting in that, because when I look at this market, I think the market topped in sort of that May. Capitulation happened in May going into June. And then we had this relief rally, which is this weird kind of, like, never seen that before, rally to an all-time high, but fundamentals wise, it wasn't reflective. It was almost overbought, and there was no substance behind it, not in the metrics I track. And so I would say we had capitulation. We're being in a bearish sort of sideways accumulation with this sort of weird ass move to 70,000. That's like an anomaly, but the fundamentals didn't support it. It came back down, and we're still in this accumulation phase similar to that bottom 3,000 in 2019, and the 150 to 250 well, 250 in 2015. So we're waiting to come out of this accumulation phase. Now this will lead you astray, because a lot of that is very dependent on like fractal imprinting of past cycles. And like, yeah, when we should have gone to close to that 100K back in last year, the top was taken out of it by the carry trade. So when we pulled back and capitulated down 50%, it wasn't 85%, because we never went into a exponential climb. Yes. You never saw MVRV go to the same heights that we're used to.
Yeah.
And likewise, the bottom was not as exaggerated. And then we had this futures anomaly, and almost, I think some part of that, I think that last leg up to 70,000 was this, you know, the futures ETFs coming online, and we got like a very sort of futures based buying. You can see where the demand's coming from. It's like people not buying the underlying, they're buying, you know, futures instruments. And then like if you're buying the futures instrument, maybe that's coming off the ETF, but that ETF is so expensive to hold that those guys are traders. So it got traded up to the 70,000 in an anomaly of a trade before it. Maybe it was correlated to like the NASDAQ and S&P, but like, yeah, it was, I think it's anomalous, but like if the data, the fundamental data looks different. And I'd say things are responding very, very quickly and differently. So like we had this very strong buying, you know, in alignment with Do Kwon's, like, you know, what is it, like almost 2 billion he's bought now over a number of weeks. So you saw this spot demand come back in from not only spot markets and on-chain, which notices that effectively, and you saw it come in on the futures, and you see the spreads expand again, and it was like, hallelujah, the bull market's back in, it's expanding. But that whole thing reversed very quickly in 1 week, this last week, and it just went from like big bullish bubbles on my model to one day of neutral and then red, and it flipped on a dime. And I think we'll see more of that as well. This thing's becoming very responsive and less, you know, long-term sort of steady, predictable. Of course, yes, okay, things move in stages. Like we had the corporate treasury push that Michael Saylor, you know, was the pioneer of, and there's, you know, like later on that led to the hedge fund push, and now these sort of institutional traders, sophisticated quant traders coming in, extracting yield. So these are set phases of it, right? That's great. You know, this is always going to happen as it gets bigger, it's mature enough, next thing comes on. But I'm really just looking at the adoption of a new technology. It's like PlanB says, it's like everybody, our neighbors, our friends, they're interested in investing in this as an asset class. And that goes through a very well understood S-curve. And you know, like I invested in Bitcoin within the week that I heard of it, because it was told to me like, oh, okay, this is like a digital version of gold. You could store a scarcity and it'd be like a gold. And I was like, it was around a very simple idea through my mind going, oh, okay, like any technology, it's going to adopt. And my analogy was, well, this is MP3s to the iPod. You know, there's going to be from one emerging, bleeding edge, unuser friendly, you know, can you remember encoding, like before your time, well, I think, then we used to encode MP3s off our CDs, and it would run like 60 minutes to encode this thing. So it'd be a little file so we could play it on our computers in a compact way. And then it took 12 years to get to the iPod. And this was tail end of 2013. So I figured, well, tail end, we'll give it 12 years. We saw it took 12 years. That's equivalent of late 2025. This would come into like a mainstream thing. And it was like the mainstream thing would be a mature market like gold, which at the time was $10 trillion, and it was $450,000 per coin. And that was my target. I'm going to kick myself if I don't buy at least one Bitcoin now for, I think it was $600. If this thing turns out to 450,000 by 2025, and I didn't invest, I'll regret it. So I went and bought one Bitcoin, and it's that adoption curve. And it is a tech story at the end of the game. No matter how much we talk about each step and financializing it, and I knew nothing of this. I knew nothing of cash and carry trades and options markets and so forth, futures markets. But as this thing goes through its adoption curve, as more and more people invest into it, and more of the industry build easy to use wallets, Lightning Network now, and the work that Strike's doing, there's all manner of innovations where it's making it easy for the common person to hold this asset as an investment. It just continues, and we are actually on track. We're on track. There's over 1 billion people by 2025 to hold this asset, and the valuations that are coming out are on track for about 500,000. 2025, I think, was it ARK Invest 2030 by $1 million. So yeah, it's roughly ballpark, and I think it's not a narrative, that's just adoption curve, and it's whatever is the next phase of this, which I guess is your question. I was like, I don't know, but I trust in the curve. I just trust in the curve. Long term, I would say, like, all the noise disappears. I think Michael Saylor said that also. Just we're all worried about the next short-term move. Maybe we go to 20. Well, this or that is, like, this thing's been going for how many years is it? 12, 13 years. Trust it, and we're in the safer range of it, and it's asymmetrical. It's a very asymmetrical bet. If you're wrong, you lose. If you invest $1 and you're wrong, you'll lose $1. Unlikely. You'll lose it all. If you're right, you'll get $10 or $20. And the probability of that you'll win is more than 50%. It's like, flip the coin, heads or tails, heads or tails. If you're right, you get $20. If you're wrong, you pay me $1. Who wouldn't take that bet? That's the bet that's on the table. You've got to be prepared to lose, because everything's got risk. But it's asymmetrical, and it still is. It's been asymmetrical for a long time. It's still asymmetrical.